Maria, Sancho, how are you? Come on in. Yeah, have a seat. So, as you can see, I have sent you your comprehensive financial plans. Now, these go way into detail, and you can get into that at your own pace as you'd like. Read every fine print and detail of that as you'd like. I've also provided here a one-page summary for you to refer to. Today, I'm just going to give you the broad overview with a little bit of explanation, and then you can feel free to ask as many questions as you would like. I've come up with a few recommendations. I'm not here to overhaul your finances. Congratulations, you're rich. These are just a few tweaks that we can begin to make over the next year or two. Now, Sancho, I know that you've said that you're not exactly interested in working with me explicitly. That's fine. I'm not going to pressure you into that. I am not a salesman. But because your finances are combined, some of these recommendations are going to overlap a little bit. That's just inevitable. Feel free to question any of these. I don't want to implement anything that you feel uncomfortable with. Maria, Sancho, either one of you, I am here to help you accomplish your goals. And so, speaking of your own goals, there were three primary goals that we discussed in our initial discovery meeting. Maria, you want to know if, number one, you're going to hit your retirement goals, the both of you. Number two, if you're going to be okay in the event of Sancho's premature death. And number three, how we can free up a little bit of cash flow to give your monthly budget some wiggle room. So to give you an overview of my recommendations first, I'll then go over the plan briefly and just kind of explain how they fit in as we go through it. So for number one, to meet your retirement goals, I suggest, number one, that we make some Roth conversions over the next 10 years, and I'll explain that, what that looks like in a minute. That's going to just maximize your tax efficiency heading into retirement. Possibly delaying Social Security withdrawals until age 70 for Sancho, and considering delaying retirement by 1 year for the both of you. Now, to protect Maria, to protect you against a premature death, I recommend that we take out an additional $4.75 million decreasing term life insurance policy on Sancho. Sancho, to kind of help protect you a little bit in the event that Maria were to unfortunately pass away early, we would take out a $2 million decreasing term life insurance policy. And then finally, I also want to make sure we convert all of your asset titles into joint tenants with rights of survivorship. This way, we can make sure that the probate process is less stressful. That's the last thing that you want to be dealing with. Mourning the loss of a loved one is having to worry about money, having to make arrangements, make adjustments. I'll make sure I'm there for you guys. But that's just going to make things a little bit smoother. That's really the goal. The goal is not a dollar amount. It's for you guys to be okay. And so that's what we want to accomplish. Finally, to increase your monthly cash flow, we can raise the deductibles on your insurance policies. We could always decrease your basic living expenses. But most importantly, I recommend that we pay off your high interest credit card debt. But we'll get to that. So without further ado, let's dig into this plan. Now, right here on page 13, we have a list of your assets. Now, these accounts, we want to make sure we have the beneficiaries listed. I'd also like to put the payable on death and transferable on death, POD, TOD, provisions on these accounts. That simply means that if and when one of you were to die, the account would simply pass to the other without any hesitation. If we change these other assets, these physical hard assets, to joint ownership, the same thing. There is no question about it when the judge goes to evaluate the probate process. That's a real simple switch. we can make that with just a few forms. Now, if you look further down at your insurance policies, you guys are well covered. Sancho is obviously the primary wage earner, so he's going to have much more coverage. If we were to lose his income, you'd want that replaced for you, whereas you've got a smaller income, which would require less coverage. Now, I think we should add another policy. This will just make sure that Maria's expenses are covered through retirement. I said that we should cover about 4.75 million. The way I calculated that, if you're wondering, we want to look at funeral and administration expenses. It's going to be about $72,000. We also want to make sure we replace the $495,000 a year that you guys have said that's what you would like in the event that one of you were to pass away. We want to make sure we cover that every year through retirement. And then finally, this is in addition to the $5 million that you're already covered for. So if you were to pass away, you do have a total of more than 9 million, close to 10 million. Now, in the same vein, Maria doesn't earn very much. So Sancho, I just want to make sure that the money is the last thing on your mind. So this is going to cover funeral expenses, her income until retirement, plus 2 years of your own income. Now, I know she helps out quite a bit with the real estate LLC, and so perhaps you might lose some income if she were to pass away. I just want to make sure that you've got a nice buffer for any income loss. Again, this is not about, I know this is maybe uncomfortable to talk about, but really the last thing that you want to have to be doing is worrying about how you're going to pay bills, or worrying about, meeting your sales quotas for the year when your spouse just passed away. And so that's just something that life insurance is going to just transfer that risk away so that you don't have to worry about it. Now, if you look further down, not worried about your property and casualty insurance. That's pretty well taken care of. You're not too worried about that. As for Social Security, I am going to come back to that. Let's take a look at liabilities here. Now, despite what Dave Ramsey might say, not all debt is evil, but some of it is hurting your cash flows. Now, I mentioned the higher deductibles and the decreased expenses recommendations. Those are really up to you. Those could help, but they're likely to be pretty negligible compared to paying off your credit card debt. See here, your Visa card, $40,000, 14.5% interest. That's $5,800 a year. MasterCard, $30,000, 13.9% interest. That's $4,100 a year. Your Discover card, $20,000, 18%. That's $3,600 a year. These store cards, $30,000 at 19%. That's $5,700 a year. This furniture, this one's the worst one, $60,000, 19%. That's $11,400 every single year. And so if we go ahead and pay off that principal, that's $180,000 expense up front, right? And yet you're maintaining the exact same net worth. You're just trading assets for liabilities. You're paying that off. But you're saving more than $30,000 every year. And so when you're looking at that month-to-month budget, that cash flow is going to have a little bit more wiggle room, about $2,500 a month if you were to go ahead and pay those off. And so I know in the grand scheme of things, compared to income, $30,000 may not seem like much, but that's going to cover those life insurance policies that I recommend. It's going to allow you to increase your savings or investing. It's going to allow you to spend more on those basic living expenses. It's going to give you a more flexible budget. So that high interest debt really ought to be eliminated if that's something that we're looking at. Now, Maria, when it comes to investing, you're pretty conservative. Sancho, you are the risk taker. Chasing higher returns, while I'm all for it, is not worth it if you are just going to lay awake, sick at night, worrying about the market. So I went something moderate, just above average, to meet in the middle. Maria, if you feel that's too high, I am more than willing to bring that back to that 44 to 58 range you see there in the middle. That way you feel comfortable. We can talk about what exactly your risk tolerance would be in the event of some market turns. We can take a look at that here after I'm done. Going down to page 20, you can see this is the current probability, and this is the recommended probability. I wanted to push you a little bit higher, but as you can see, you guys are not in a bad place at all. I mean, we've got lots of flexibility here. We don't have to. You're not behind at all when you're looking for retirement plans. You guys are good, and so let's have a discussion about that. Now down here, this also shows the 1 year delay in retirement. Now, I always tell my clients, don't look at the first year you're in the market. Look at the last year you're in the market. 1 extra year allows you to make another year's worth of income. Plus, it decreases 1 year out of withdrawing and allows 1 more year to receive contributions and compound interest. Now, by reducing basic living expenses, that's a savings of almost $2 million, which is nice, not necessary. It's your life; you spend your money how you like, but it's just another precaution to ensure that you can further ensure the probability of success. Those two together, again, like I said, they're nice. They're not necessary, but by delaying that 1 year in retirement, you're going to see close to $1 million in savings. By decreasing those living expenses every year, that's going to be $2 million. Now, this allocation wants you to increase your exposure to stocks. It's actually not all that necessary. It's going to introduce more risk for the same return. That's not necessary. I'll skip down. The Social Security measures, again, this is something it's minor. It's only going to save you about $100,000, or actually earn you about $100,000. So again, it's not necessary, but by delaying it until 70, it's actually going to increase your monthly, your annual returns. It's only going to take a year to break even on that. Now, this Roth conversion, essentially, what we have is your qualified IRA, 401k. Those are going in as pre-tax. So you didn't pay taxes on them originally when you contributed. It's been growing tax-free. When you bring it out, however, it's going to be taxed at a much higher rate, given how well you guys have done. And so if we actually convert them over the next 10 years, then you can pay the taxes now, and then you get time to let that grow tax-free. And so by converting that, we're actually going to save you about more than $2 million in tax savings. Now, the rest of this goes into a little bit more detail with long-term care, disability, life insurance, estate planning. We can go into that, but this really focuses on the 3 goals, 3 questions, concerns that you had. So it's really all I've got for you now. We can always begin discussing some gifting strategies later down the road when you get within range of the estate tax, what sort of legacy you'd like to leave your son. But just to recap for you guys, we can save about $2 million on the Roth conversion, an extra $100,000 in retirement by delaying Social Security. By delaying retirement by a year, we can earn you another $1 million. By taking out 2 decreasing term life insurance policies on each other, it'll just help you guys protect each other from premature death. Right? Life insurance is not about you; it's about the person you love. By converting asset titles to joint, again, that's just going to increase your peace of mind in the probate process. That's the last thing that you want to be worrying about in that case. And then we can save about $2 million by decreasing your monthly living expenses, your basic living expenses, and we can save about $30,000 a year to increase cash flow by paying off those high interest credit cards and staying away from them. So that's all I've got for you. What kind of questions do you guys have? I'm open to anything. Let's hear it.